Hello and welcome to Livewire's The Pitch. I'm Ali Selby and today we'll be learning about something that you may consider a black box. It's quant investing. We're going to be breaking down the red tape that surrounds it, and to do that we're joined by Bruce Apted from State Street Global Advisors. Thank you so much for joining us today, Bruce.
Ali, great topic. Lovely to be here to chat about it today.
Obviously, quant investing has been dubbed a black box.
Yeah.
Distilled really simply, without any jargon, what makes it different to fundamental investing?
Look, I'm glad you brought up that point about black box because I think it is a bit of a misnomer in the markets. I think it's an unfair characterisation, and it's normally something that people will put out there that don't understand it. So they're just characterising something with a throwaway line. So I think it's really unfair. I go so far as to say is that all of our factors in our process are transparent and fundamentally based. When we think about researching a topic or a potential anomaly in markets, we start with economic rationale. That is front and foremost to how we think about it. We're trying to understand mispricings in markets, mostly based around behavioural biases. And to do that, we need to understand what it is that how do humans react to these certain circumstances, and how does that create a mispricing? Where fundamentals and quant should go together. I would actually go so far as to say if someone has a black box quant process, run for the hills, because I think it's very dangerous. You need to have that transparency because it helps you understand what's working and what isn't working at different times, and also so you can decompose it. It's like like having a car not knowing how to fix the engine in the car. It's a problem. You need to have that transparency and be able to understand what's going on underneath the hood.
Okay, but what is quant investing? What makes it different?
So what makes it different? I think there's probably lots of different ways you can think about it being different. But for me, one of the key characteristics is that we'd say that quant's about probability, not perfection. So if you're a fundamental manager and what you do is a very deep dive on these stocks, you know them super well. You're speaking to the customers, you're speaking to the suppliers, you're questioning management about strategy. There's a lot of work that goes into it, but you're focusing on one stock. So what we can do in the quant world is we can apply fundamental analysis on those stocks. We don't go as deep, but we go much broader. So it's all about breadth. And if you ever speak to quants, they'll always go on about breadth because it's the answer, right? So a really good way to think about it, and something I often talk to people about to understand the concept of breadth and getting your expected value in the long term, is tossing a coin. You can toss a coin once or twice and you could get two heads or two tails, right? The outcome is you're not going to get your expected value with such a small sample. If you toss that coin 1,000 times, you're much more likely to get 500 heads, 500 tails, or very close to that even distribution. So we call that getting your expected value when applying breadth to it. And so that's the edge that quant has, is it's about not perfection of knowledge, but enough knowledge to give you an edge and then applying it in a really consistent way. So I think that's something that quant does very well, and that's something that we focus on in our business.
There's over 30,000 stocks in your investment universe. How does a company make its way into the portfolio?
Yeah. So, Ali, we do run different types of portfolios for different investors. So, it's hard to generalise exactly how many numbers we have. But if we're thinking of one of our global enhanced mandates, for example, that would typically have an MSCI universe of about, in that universe, there'd be about 1,600 names. But how many names do we have in the portfolio? Typically, depending on the tracking error, it's around about 600 names. But what the key thing is to understand is what we're looking at is active bets from that benchmark in that style. So we literally have active bets across those full spectrum of companies in the universe. And what we're trying to do is take a large number of small active bets to get exposure to the best ideas while also reducing our exposures to our risk factors in our process. So that's it's all about getting consistent results, getting exposure to the best ideas and themes without getting too much stock-specific risk, and controlling risk factors like sector exposures and different things like that.
Bruce, before you talked about mispricings and how quant can take advantage of that, what creates market inefficiencies?
Yeah. Okay, great question. And I think it goes to the heart of an investment philosophy is how do you think about mispricings, how do you go about finding them, and then how do you go about exploiting them? And there's lots of layers to that as well. So for us, first I'd just say blanket-wise, there's lots of different inefficiencies in markets, and you can develop investment styles to try and exploit them. For us, what we're looking for is mispricings that are persistent through time, so they're repeatable. And also they need to have a certain duration, if you like. They need to be something you can exploit over a period of time, because if it's very short term, it can be an anomaly that's there, but you can't actually capture it in real life once you take into account trading costs, etc. So what we look for is enduring, repeatable anomalies, and the best way to find those is to find ones that are linked to behavioural biases. Because those behavioural biases, as humans, we like to think we're rational, but there's a lot of emotion in our decision-making process, and it's that interaction there with how investors are looking at securities, assessing the information around securities, and mispricing those securities, which creates opportunities for us. So maybe I'll give you an example of one that I think everyone would understand and relate to. So as humans, we tend to over-extrapolate recent events. So where there's some sort of crisis going on at the moment, we tend to say, okay, that's happening at the moment, it's a terrible thing or a really good thing. We're going to expect that we think that's going to happen into the future for longer than it actually does. So it's called over-extrapolating short-term and not really thinking about the long-term effects. And that happens in the context of markets. Stocks with good news, people will over-extrapolate that too far into the future. Not just 1 year, 2 year, 3 year, but they might extrapolate it out 10 years. And suddenly they're pricing a security on unsustainable types of growth. Equally, stocks that are going through a really difficult time, people give up on them. People just say, I don't want to be in that stock anymore, that story's gone, I just don't want, it's too hard, I don't want to go there. So they'll basically discount that stock more than it needs to be. And so you get these mispricings in valuation that's set up based on that behavioural bias. And we just see investors continually repeat that process over and over.
Are there any other long-term human biases that you believe investors should be aware of?
Yeah, well, lottery effect is another one, which is how investors think about payoffs and the sort of stocks that they gravitate toward because of those payoffs. The other one that I think is a really strong bias, and I think has actually become worse as social media has become bigger in society, is confirmation bias. So if you believe in a certain theory, you can go onto the internet and find someone who's going to support you with that theory. And we have lots of echo chambers now, which are circular, where people speak to people of like minds, but they don't go outside, talk to people outside of that. And so that creates this, it just reinforces confirmation bias around ideas. And I think that can also lead to sort of mispricings in securities as well.
Okay, well, thank you so much for your time today, Bruce. I really enjoyed that conversation.
Yeah, it was great. Thanks, Ali.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.